What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. In today's show, we'll discuss the latest FOMC meeting, the amazing year CME Group had with some new products they added, and why traders should be using the CME Fed Watch tool as a resource for trading these markets. Today, my guest on the Futures Radio Show podcast is Managing Director and Global Head of Rates and OTC Products at CME Group, Agha Mirza. Today's podcast is brought to you by CME Group. Whatever the obstacles, CME Group provides the tools that global market participants need to manage risk and capture opportunities. With 24-hour access to futures, options, cash, and OTC products across all major asset classes, you can drive your trading strategy forward with confidence and precision. CME Group, where risk meets opportunity. Agha, welcome back to the show.
Anthony, thank you for having me back. Great to be talking to your traders today.
It's great to have you. You know, Agha, this is my last show of the year, and we're going to talk about this latest FOMC meeting, which obviously everybody was tuned into, and of course, CME Group's markets were there for traders to go in and to hedge their risk and to trade for some opportunities that maybe they saw. So we're going to talk about some of the amazing products that CME Group has added this year. We're going to talk about some of the products that we think traders absolutely that CME Fed Watch tool should be using, especially in these markets, what's going on with the Fed. And then, of course, we're going to maybe we start with this. We start with, what were your thoughts on this latest FOMC meeting?
Anthony, first, I feel very special doing the last show of the year for you. I know you have a great following and a great show, so thanks again. And indeed, it has been a very special and busy year. You mentioned the FOMC meeting just yesterday. Obviously, it marks yet another rate hike in what has been a series of record-setting rate hikes. With the 50 basis point yesterday, the Fed has delivered cumulative 425 basis points, 4.25% of rate increases this year to obviously combat what is proving to be persistent and very high inflation if you measure it by the standards of what we have experienced in the last few decades. So very busy and active market, lots of risk management and hedging needs, and therefore trading opportunities for our market participants.
Yeah, and with the US Treasuries front and center, that also brings the macro environment and recent Fed activity to mind. So what's your take heading into 2023?
You know, um, inflation remains is still very high. We all know that the CPI, the headline number, exceeded 8% earlier this year. Recently, it has moderated to about 7.3% year over year. Having said that, as the Federal Reserve Chairman Jerome Powell noted himself yesterday, that even the core number, which tends to be a little lower, core means excluding food and energy prices, the inflation is running at about 6% year over year, which is three times, and that's what the chairman noted, three times the Federal Reserve's own target of 2% of inflation. Typically, when inflation as a genie is let out of the bottle on the wages and services side, it can be sticky. So, from our perspective, and as the Fed has indicated, rates will remain elevated for some time to come. The market, if you look at our markets, Fed Fund futures, they are pricing a couple of additional rate increases potentially next year before rates come back down. So there will be uncertainty. We think that there will be market participants who may think rates need to go higher. There might be some who later in the next year might think that rates need to be cut. For all those reasons, risk management and trading needs will persist. And as has been the case this year and in prior years, CME products, be it Treasury futures and options, SOFR futures and options, Fed fund futures, they will continue to be very valuable and important liquidity pools for market participants to manage their risk. In fact, this year, we had yet another record year of activity, and that is on the back of 10 years of very strong performance. Last 10 years, the CME interest rate volumes have grown at a compound growth rate of 9% on average every year. So, lots of hedging and trading needs that our market participants are using CME products for.
Yeah, it's been a year, almost a year since we spoke. We spoke back in February, and it's been obviously a strong year for interest rate business at CME Group. You talked about how it's been such a good year for the products, and obviously in a Fed raising or cutting environment, let's face it, you guys are really the only place in town really to trade these interest rates. And I know we've seen you guys add a bunch of new products, which I think have been great. And maybe we could touch base on that. Maybe you just talk about how everything is really shaped up with the existing products, and maybe talk about some of the new products that you added in such an important time in market history, with the Fed being the main focus and interest rates.
Absolutely. Since we were just catching up on the macro environment, perhaps I'll first talk about some of the existing and recent products. Our Treasury futures and options, they are making new records, very, very important and large markets. The SOFR futures, which I know, Anthony, we have talked about a couple of times, at least on this show in prior years. SOFR futures and options were listed in the last few years. This year, they have really exhibited strong historic record growth. SOFR futures and options have now grown to about $35 trillion in notional market size, trading over $3 trillion in notional every day. So very important short-term interest rate product. Our Fed fund futures, they obviously in relation to the Fed activity are proving to be very, very important and actively traded. But one recently launched product that I'd like to talk about are the yield futures, which were launched last year and have continued to grow, especially in terms of the number of users. So what are yield futures? They are a futures contract that enable market participants to trade US Treasury instruments in simple yield terms. No price to yield conversion. Just directly you can observe, monitor, and trade the yield numbers. And if you look at the yield numbers, for example, at the most actively traded yield futures contract is the 10-year yield futures contract. 10-year yields have moved from a historic low of 0.6% back in October 2020 to 4.2%, which was a sevenfold increase by October 2022. That kind a sevenfold increase in just 2 years is obviously very significant and historic. Now the 10-year yields are back down to 3.5%. So lots of movement, especially on a percentage basis. And that is why investors, institutional clients, individual traders, they have been actively trading the 10-year and the entire Treasury yield curve. All of that, relative to the usefulness and the simplicity of the micro yield futures that I'm talking about, they have grown now to over 8,000 participants. Again, simple to trade, highly useful, especially in this environment. I highly encourage your market participants, your listeners, to take a look at CME micro yield futures.
I do want to take a moment and just talk about the micro yield futures because I think specifically for a lot of the independent and retail traders out there that are trading futures, or even if you're trading stocks and you want to know what the interest rates are. In the past, I would look at the 10-year or the 30-year and I'd be like, how could I figure out what this move is representing in actual yield terms, right? Because the 10-year, 30-year, 2-year, 5-year, they're not priced in yield, right? That they have different pricing. So, and when rates were going up, the products were actually going down, right? So it's that opposite thinking. Then CME Group comes out with the micro treasury yield futures, which for me as a trader, I really appreciate it because if you think the 2-year yields are going up, you actually buy them and they go up and you can see the percentage, and that just makes it easier for an equities guy like me who trades S&P, buying if I think rates are going up, selling if I think they're going down. But I think for the other traders out there, if you're not trading rates, you could go and see these. So you pull them up on your platform and you could see what the 2-year, 5-year, 10-year, and 30 is live because there's actually a market on it. And Aga, I think to me, this is one of my favorite new tools and markets that CME has brought to the table.
Absolutely, fully agree with you. Anthony, you mentioned that the number of your listeners are traders who trade across market segments, commodities, energy, equities, you name it. So for such market participants, often there are big themes that make interest rates an attractive market. We talked significantly about the Federal Reserve raising rates to combat inflation. To go with that, the Federal Reserve is also reducing its balance sheet, which, as the official sector Federal Reserve addressed the economic impact of the pandemic, for example, they had to increase their balance sheet by buying treasury and mortgage products on the balance sheet, which rose to a historic high of 9 trillion. To combat inflation, they are now reducing the size of that balance sheet, and that process started in September. The Federal Reserve just yesterday, in its statement, confirmed that they will continue on this recent path of reducing the balance sheet, which is down from a peak of $9 trillion by September of this year to currently $8.6 trillion. When that happens, what that means is the Fed is buying less treasuries, less mortgages, which means that the market participants have to absorb this. So, just to simplify, there are big themes such as the Federal Reserve raising rates, such as the Federal Reserve reducing its balance sheet from 9 trillion down to some smaller number. And those big themes might be interesting enough and attractive enough for your traders to look at interest rate market. And exactly to your point, when that is the case, uh, you know, uh, uh, we wouldn't want them to necessarily engage in the complex price to yield calculations. And that's where the micro yield contract comes into play. If the 10-year yield is 350, if you believe that it's going higher, you buy the contract. And if you believe that it's going lower, you sell the contract. And by the way, the contract sizing is very simple. $10 a basis point, or $10 the the main increment, from 350 to 351 for one contract, you have made $10.
Yeah, no, thank you for talking about the specifications of those products as well, because it's extremely important. And I'm just going to play this simply out there for traders. This is an interest rate environment. This is the time you need to be watching them because they impact everything that you're doing, whether it's in your trading or your everyday life. And this is a tool that I look at every single morning, and it's extremely important to pull up. And I know we're going to talk about more products, but I do want to talk about there's a lot of news right now around US Treasury yields. What are your thoughts on the broader implications of this?
You know, the US Treasury yield curve is currently inverted. The 2 year to 10 year is most inverted that it has been historically. 2 year yields are 4% or so. 10 year yields, as we mentioned, are 3.5%. Going forward, the market is expecting maybe 50 basis point of more rate hikes, and you can check CME's Fed Watch tool, which translates market's view from the very large CME Fed Fund futures market into probabilities of Fed hike. So um, potentially, the consensus view is that the Fed raises rates by 50 basis points more, and if it does that, maybe the short end yields rise a bit more. For the long end part of the curve, when you look at 10 year and 30 year, recently they have come back down from the highs by about 60 to 70 basis points. What will be interesting to see is that as the Fed reduces its balance sheet at the current pace of $1.1 trillion per year, meaning the Federal Reserve will be buying US Treasuries and mortgages less, leaving as much as $1.1 trillion for the market participants to absorb. Generally, one would expect that that's an upward pressure on the yield curve, but time will tell.
Yeah, I was looking at the yield curves the other day, and I'm not sure that I saw one that's not inverted. Am I wrong? Even all the way down to the really, really short end.
You are correct. If you start at the 3 month or 6 month point, from numbers like 460 to 470 basis point, 4.7%, let's say, around 6 month point, uh, going down to 10 year yields of 350, or this morning I saw them 347, the yield curve is indeed very inverted.
And in your experience, Aga, I know, is there a time where you've seen this before and we've not had a recession? Because you know how everybody talks about the inverted yield curves. Is is that a likely scenario? Is this still a good indicator of that?
I would say that historically, on most occasions, when yield curve became noticeably inverted, a recession showed up in the following quarters. The US economy is already slowing down. Having said that, um, there are differences this year. One difference is that the unemployment rate in United States is very low, historically extremely low, 3.6%. So if there is a recession and the unemployment rate rises by, some part of a percent or a little more, it would still be a very healthy economic makeup. The other difference is that uh, historically, when yield curve was inverted, the Federal Reserve was not running such large balance sheet. In other words, the Federal Reserve did not have a buy and hold strategy for trillions of dollars of US Treasuries and mortgage market. So personally, I wonder if that dynamic that has prevailed since the global financial crisis, and the Fed started to increase its balance sheet from less than a trillion to 4.5 trillion, and then subsequently to combat the downturn from the pandemic, the Federal Reserve balance sheet increased from 4.5 trillion to 9 trillion. Those sizes of treasury and mortgage holdings didn't exist in the prior scenarios when the yield curve was inverted. So time will tell, but in general, most economists expect that there will be some form of, reduced growth or shallow recession in the coming year or two.
Yeah, thank you for sharing some perspective on that. And I think it's always important for traders and investors to understand the context of the situation, right? It's not just as simple as inverted yield curves equals this, but this is once again why you need to watch these tools as an investor or as a trader because they are showing some signals, but look at the context of the situation. And I've heard similar things about the jobs, and I'm not a macro person. I'm just a trader out there trying to trying to turn a buck, Aga. And so I look at these little nuances that are happening, and it's just very interesting. And I appreciate you explaining that to us because I just think, once again, it's extremely important. I want to move on to talk about some new products in 2022 that you guys have launched at CME Group. Can you tell the listeners about that and the market demand for them?
Yes, thank you, Anthony. As you know, and we have worked together for a long time, CME is always studying the market structure very closely, always engaged with our clients, trying to understand their need and taking steps to help solve their issues and deliver more cost efficient, effective futures and options contracts. So in that regard, I will note four new products that we have launched this year in our short-term interest rate complex. We most recently launched the German and Italian repo funds rate futures, and we have launched the Ester futures. In our long-term rates, we have launched the 20-year Treasury future, and we have launched the TBA future. For your listeners at this time, it might be helpful to elaborate a bit more on two of these products. So, on the short term side, Ester futures are really unique, and we are very excited about them because Ester is a overnight rate for Europe that corresponds very closely with the European Central Bank target policy rate. Similar to most developed markets, US and UK, the European Central Bank is also active and has started to increase interest rates. So, in this environment, there are increased needs for risk management. On the European side, the Ester futures are constructed in a similar manner as the highly successful SOFR futures in the United States, and they essentially provide an ability to take views and manage risk with regards to the Ester European overnight rate. Ester futures were launched about a month and a half ago. They have traded essentially every day since launch. We have traded about um, uh, thousands of contracts, and we have dozens of market participants who are taking advantage of the standing liquid markets, standing prices in Ester futures. If your listeners are interested in the European monetary policy and look at it, highly encourage them to utilize and look at the Ester futures. So TBA futures provide access to the very large mortgage-backed securities market in the United States. The mortgage-backed securities markets is about $300 billion in average daily trading volumes. Mortgage-backed securities are essentially various kinds of packages of individual mortgages. The mortgage that people like you and I, Anthony, and regular folks, mom and pops, and everybody else takes in the United States to finance their home purchases. These are packaged in the so-called mortgage-backed securities. And we have created futures on them. They are called TBA futures. Mortgage market is interesting to investors because mortgage rates are typically higher than the US Treasury rates. So, for greater yield, investors come to that market, and that market has its own supply and demand dynamics, and therefore sometimes the spread between mortgages and treasuries may move around. So at CME, you can trade TBA futures for outright mortgage level of mortgage rates, or as a spread to the Treasury futures contract for the spread between mortgage and US Treasury yields.
CME Group is always putting out products where the demand is. And I know from talking with Agha, Tim McCord, and everybody there. And that's why I always ask that question, where is the demand coming from? And they work so closely with the clients. It's always great to see these new products coming because of the relationship that CME has with the clients. And it's great for traders because it allows us to precisely manage our portfolios and trade where we want to trade. And it's extremely important. And I just want to say you can go to cmegroup.com to learn more about some of these products that Agha is talking about. And really the final thing today I want to talk with you about, Agha, is the CME Group FedWatch tool. It is by far the number one tool that I use on CME Group. I'm almost going to the CME FedWatch tool on a daily basis. I think it's great. And as we mentioned today, this is an interest rate environment. I talked about this in the beginning, that this tool is so important because there really isn't a macro person I don't have on Futures Radio Show or I see on Twitter or anybody out there that doesn't use the CME FedWatch tool because it tells you what the percentage is and what people are putting real money on as to what that actually the Fed may do. And it's not just people guessing. This is there's a market there, folks. And this is extremely important because it tells you what the sentiment is and what people are thinking leading up to these meetings. So Agha, explain to everybody a little bit about what the CME FedWatch tool is and why it should be a resource that all traders use.
Anthony, in a nutshell, CME FedWatch tool allows everyone to have a pulse of the market. It is available equally and freely for everyone, no login, no subscription. And that is something that we are very proud about. And very importantly, as you mentioned, there are very, very large markets where market participants come to express their views on what the Federal Reserve may do. If you look at the CME Fed Fund futures markets, it has 1.5 million contracts open interest. That in dollar terms is about $7 trillion in notional size. So what that means is that in this large market, many participants, banks, asset managers, investors, hedge funds, individual traders, they all express their views. And that buying and selling results in pricing, which effectively is kind of market's view or consensus at the time. What the FedWatch tool does is it uses a transparent, a very thoughtful methodology that is available on our website to translate the prices of Fed fund futures into into probabilities of markets expectation of what the Federal Reserve may do in terms of increasing, decreasing, or holding constant their interest rate policy in the upcoming meetings. The tool is very user friendly. This year, I would say that the Federal Reserve has matched the tool's expectation of the rate hike. So, for example, in most meetings for this year, in nearly all meetings this year, whichever size of the move, 75 basis point or 50 basis point, the CME FedWatch tool put the highest probability expectation that indeed was the outcome. So again, these are probabilities. These are derived from the market pricing, and market pricing can change at any time. But if you are interested in learning from what the market participants and traders think, you don't have to do your own Fed fund futures to probability calculation. You can look at our methodology and our tool, and indeed, across global media and across market participants, the whole world is using CME FedWatch tool in our experience. This year in particular, the usage has skyrocketed, and we are very pleased about that.
Yeah, you should be because it's an amazing product. And like I mentioned, there isn't a macro person I don't have on this show. People on Twitter were referring to it all the time because it is what the big traders, institutions, where the money is flowing into, and CME has a tool that uses what the market information is to give you that sentiment, right? And to give you that percentage, which is so extremely important versus people doing a poll or other things like that. That doesn't matter. This is a market telling you this is where people are actually putting their money where their mouth is. And for traders and investors, it's great to be able to see where that bigger money is anticipating, because if in an interest rate environment, if there is a surprise, you know what the market's anticipating based on that CME Fed Watch tool. So Aga, once again, I can't thank you enough. I'm always learning something every time we speak. It's always great to speak with you. Like I said, you're the last show of the year. It's been just an amazing year, right? Just a very busy year in markets. And thanks to CME Group, we have futures markets for people to hedge their risk and for traders like me to go out there and find some trade opportunities trading some of these markets. So it's great to go beyond the charts and hear from you and what's going on with CME Group.
Thank you, Anthony. I really appreciate this opportunity, and I'd like to wish a very happy holidays, and happy New Year to you and your listeners.
Thank you so much, Agha. I appreciate that. Everybody, remember, you can follow what CME Group is doing on Twitter at CME Group. And to learn more about the products discussed in today's show, go to cmegroup.com. And I'll see you guys next year. See you, everybody. Bye. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.